viewers, you are watching the Savera and I am Manpreet Kaur. A worrying report has sounded the alarm on the gold and silver markets, and investors everywhere are paying attention. Precious metals that have been viewed as safe havens are now flashing danger signals after an extraordinary rally and an abrupt crash. Here is what you need to know. Gold and silver prices have seen extraordinary movements in recent weeks, with metals that typically act as safe havens suddenly shifting into highly volatile territory. According to a new market report, this behavior may indicate that the rally in bullion prices has crossed from calm markets into speculative frenzy, and that some things investors cannot afford to overlook. The report titles Gold is Talking, Silver is Screaming comes from White Oak Capital Mutual Fund, which analyzes that the recent dramatic shift is in gold and silver prices and warned that the metals valuations dynamics have entered a phase seen in previous markets bubbles. What set this movement apart in the speedings and magnitude of price changes, especially in silvers, traditionally the more volatile of the two. Just 24 hours after gold futures hit lifetime highs on the multi-commodity exchange in India, price plugged sharply. April gold contracts collapsed nearly 9% on January 30th after soaring to unprecedented levels, wiping out gains equivalent to nearly 25,000 rupees per 10 grams in a single session. Silver's falls was even more dramatic, with March futures tumbling 17% after reaching all-time peaks only a day earlier. According to the reports, the fundamental concerns revolved around the gold to silver ratio, a key metric that shows relative values between the two metals. The ratio has compressed to roughly 46:1, far below its 10 years average of around 80:1. A historic signals that silver is no longer cheap relative to gold and may be in a speculative bubble phase. Historically, similarly, low ratios have preceded steep corrections in silver prices, often sharpens and more prolonged than corrections in gold. Experts emphasize that while gold traditionally reflects broad macroeconomic stress such as geopolitical instability, currency weakness, and systematic risk, silver's parabolic risk is often driven more by speculative demands than by fundamentals. The report points out that silver's dual roles as both a precious metal and an industrial commodity can amplify moves in either direction, exposing holders to both upside and downside risk. Markets observers also noted that precious metals do not generate cash flows like equities, unlike stocks which offer dividends and reinvested earnings. Gold and silver rely purely on price appreciations for returns. In striking contrast, major equity indices such as India's Nifty 50 have delivered comparable or even superior long-term returns while offering tax advantages like annual exemptions on long-term capital gains. So what does this means for investors? The White Oak reports recommends prudence and rebalancing rather than chasing last year's meteoric gains. Specifically, it advised trimming positions, especially in silver, which has shown signs of being overextended, and reallocating gains into diversified equity funds or blue chip stocks. For moderate investors, keeping metals at around 8 to 10% of total portfolio values is suggested, with the slightly higher allocations for those willing to take more risk. While gold and silver remains integral components of diversified portfolios, often serving as insurance against inflation and economic uncertainty, chasing them at peak valuations can lead to significant downside risk if the speculative momentum reserves. In short, gold and silver may still hold values, but the current booms has warning signs that investors should heed. Markets can shift quickly and accordingly to the latest. That's all for now. Stay tuned with us for more updates. Do like, comment and subscribe our channel.